So we tend to look a little bit different, and that's part of being away from Wall Street.
Hello and welcome to Signals by AlphaSense, where we hear thoughtful insights from business leaders, investors, and experts.
Hello and welcome. You're listening to Signals by AlphaSense. I'm your host, Nick Mazing. Today we're joined by Meb Faber, who is the founder and CEO of Cambria Investment Management. Cambria is a niche ETF manager with 12 ETFs and around $1 billion in AUM. So we'll discuss how Cambria has been successful in a world that is really dominated by the big three indexing ETF companies, and Meb is also the author of several books on asset allocation. I was an editor of one of them years ago on global asset allocation. He's also the host of the Meb Faber Show, which is a great podcast. I strongly recommend that. And he has a weekly newsletter from the Idea Farm. I read that as well. He links to a lot of interesting research papers that he curates, and we'll have all the links in the show notes. Meb, can you tell our listeners a little bit more about you and about Cambria?
Sure. Well, it's great to be here. I love as we continue to grow and get bigger, I'm looking forward to losing the company descriptions. I was talking to Wall Street Journal this morning, and people will describe us as an emerging manager. I'm like, yo, we're 15 years into this. Our ETFs are now 10 years old. And in any other part of the asset management industry, $2 billion, almost, I'm rounding up, $2 billion in AUM, you're no longer niche. But the problem with asset management, you're talking about some firms with a T at the end of their name, like Vanguard, would have trillions in assets. So it's a big space. But yeah, look, we're a little California, Los Angeles-based boutique here in Manhattan Beach. Listeners, if you're in the neighborhood, come say hi. We're pretty different. We tend to be, we like to say, concentrated and weird. The reason being is we live the best time ever to be an investor in history. You can invest in a limitless buffet of choices, stocks, bonds, real estate, commodities, on and on and on. And you can do it for free. So trading commissions are zero. You can buy the global market portfolio, which is roughly half stocks, half bonds, half US, half foreign, or half ex-US, smattering of real assets mixed in for almost free, zero. It's like 0.04%. That if you include the short lending, which we may come back to later, you're actually probably already at zero or negative. You're getting paid to own this. Best time ever. So in a world of 10,000 plus funds, why in God's name do we need any more? We probably don't need 1,000 funds. Well, as you look around the landscape, the basics are covered, but there's a lot of areas that if you plan on moving away from market cap weighting, from the basic indexes, and you want to be an active manager, you want to try to generate alpha, right? You have to be weird and concentrated and different. And the problem is a lot of the strategies out there, they say they are, but they really just look like a closet index. So we try to exist in this tiny little dark corner of the investing world where we have no competitors. And so we have 12 funds. We like to say we're quant, but it's really quant lite. Those funds range from very plain vanilla strategies like long only equity to much more esoteric and niche things like tail risk and trend. But there's 4 criteria that we use when we launch funds. First being what I alluded to, the strategy can't exist, right? So it can't already be out there. And if it does exist, it has to be something we consider to be, we're going to do it much better or much cheaper. All right, better, look, subjective, lofty goal. Cheaper, all 12 of our strategies are cheaper in the category average. A couple are the cheapest funds in the category. Now that's only because Vanguard's not around, but we're happy that's the case. Most funds are just too expensive. 2, it has to be something where we've published our own research or there's a lot of academic and practitioner research already. So 2 of the biggest pillars we focus on are value on one side and then momentum and trend. Both of those have 100 years worth of academic and practitioner research. We put our own spin on it. Third, it has to be something I'm going to put my own money into. The vast majority of mutual fund managers, I shouldn't say the vast majority, the majority of mutual fund managers have $0 invested in their own fund, which I think is a travesty. And lastly, it has to be something investors actually want. We have a handful of ideas that Meb thinks is brilliant. And we may put out one day, now that we're getting to size, maybe when we're 5 or 10 billion, but I don't think anyone else on the planet would like them, at least not yet. So we tend to look a little bit different, and that's part of being away from Wall Street. But we like to say we're quants that have a big appreciation for history and put it into practice.
Mm-hmm. And now let's talk about the different strategies that you offer. Now, you build a business really around shareholder yield. And when you look at like different investment concepts, so you look at tail risk, that's the black swan, that's the lab, right? You look at risk parity, that's Ray Dalio. You look at, the endowment model, that's Swanson. I think of you as the shareholder yield guy, and certainly takes a more holistic approach to really capital return. So can you tell us a little bit more about shareholder yield and how you productize the strategy? Because you started with
Sure.
US domestic, and then you expanded to developed markets and emerging markets.
Yeah. So we launched our first shareholder yield. It's going to be 10 years ago this spring. So getting old. We've been in this business a while, but it's fun to see. So we have three. We have the US, which is SYLD, and the foreign and emerging, which are FYLD and EYLD. And look, we don't claim to have invented this concept. In fact, it's an idea that has been well documented in research in the financial literature, from Jim O'Shaughnessy on his classic What Works on Wall Street to academic papers, on and on. But at its core, the big phrase of 2022, first principles. If you go to first principles, what do you want when you own a company and a stock? You want a great business that's high quality, that's generating a lot of cash, and sloughing off this cash, returning it to shareholders, so keeping management honest through dividends and buybacks. They're not doing it by loading up a ton of debt. That sounds like a good business. That's like a Warren Buffett-esque business, like security analysis 101. And what's important about this concept of shareholder yield is that in the financial markets, sometimes the rules change or sometimes the landscape shifts. So dividend investing, the best marketing strategy ever, like people resonate with the concept of, hey, I'm getting checks in the mail, dividends, right? Coming out of the earnings of these companies. And dividend investing, historically, investing in high dividend stocks has been a good investment strategy. The reason it's a good investment strategy is it gives you a slight value tilt. So the higher dividend yielders are usually simply just because the price is low, but you're also avoiding the expensive stocks. It's not a particularly good value tilt, but what's important to notice, and there's thousands of dividend funds. What's important to notice is the shifting sand. So companies have always been doing buybacks, despite what the politicians say. It's been going on for 100 years. Share counts can go up when they issue shares to executives to fund the business. They can go down when they retire them. But it really started to change in the 1980s. 1980s, companies started to feel like they had safe harbor for buying back shares. So stock buybacks, which are very maligned and particularly misunderstood, are nothing more than a tax-efficient dividend. Just scratch buybacks from your memory and say tax-efficient dividend, flexible tax-efficient dividend. And so executives and companies are well suited to use whatever tools to maximize shareholder return. And so if you have these flexible tax-efficient dividends and your stock is trading below intrinsic value, Warren Buffett said this isn't a Meb quote, there's no better way to improve returns. There's no better investment opportunity if your stock is trading at below intrinsic value than to buy back shares. So buybacks starting in the 80s started inching up, and really starting in the 90s, eclipsed dividends on aggregate as a way to return cash to shareholders. So if you're a dividend investor and you're ignoring buybacks, you're ignoring half of the ways that companies distribute their cash flow. You can't do that as an investment analyst and be honest and say, I'm incorporating all information. What's interesting, and you have to use net buybacks, is because some companies will just issue a ton of shares to execs and then buy back, and you have a zero net difference. But also think about the dividend investors. You're excited, you see this fat 4% yield, but because you're ignoring buybacks and issuance, what if that company is issuing 5% shares per year? Well, really you have like a zero yield. And so the dividend strategies all miss this. So we launched this and we expected there to be dozens of competitors to these funds and strategies, which have performed great over the past decade. And there hasn't been really any, which half of me is elated. Our largest one is about to hit $1 billion in assets, but also I scratch my head a little bit because once you take the pill And you say, oh my God, how could I be not using this information of how companies distribute cash? I don't know how you go back to saying, okay, that's fine to just ignore. Let's ignore that piece of information. So we're obviously biased, but we think it's a very sound investing methodology. The great news, huge news right now, 2023, is this value trade is one of the best times in history, we think, to put on this trade. So value's had a nice run the past 2 years, really peaking in the craziness of February 2021. But if you look at the spreads, particularly globally, but also within the US, you're still top decile, in some cases, top couple percent in history for the value spread. So a lot of the expensive stuff has got crushed, but a lot of the cheap stuff, particularly in emerging markets and foreign developed, we think could be the trade of the next decade. So we're excited.
Yeah. And it's interesting that a number of companies that when you look at companies with the largest shareholder return in the last 10 years, 20 years, they're the share cannibals like AutoZone, right? They've been buying back stock forever. I don't think they pay a dividend, right? It's very interesting to see how, is the share, it's a little bit of a moment of truth, right? When you have on the call, when executives say, we are initiating a buyback, but it's offsetting dilution. And then share count actually goes up and up and up and up. And then you have companies where every year or almost every year, the share count goes down, which increases the value for the current shareholders.
That's a good Munger phrase. He says, look for the cannibals. You want the ones eating themselves. Now, there's no more beautiful chart than we come up with the shares outstanding just slowly year over year. Now, but what's important about this strategy is you have to have a value filter. And so Berkshire does a great job of this, right? They say, hey, we'll buy back stock when it's below like 1.3 times book.
Yeah, 1.2, 1.3 is the number.
And CEOs on average do a great job. So if you look at the big buybacks where it's 5% or more shares outstanding per year, they usually trade at a significant discount to fair value. And the ones that are issuing usually trade above fair value. Last thing you want is an expensive company buying back shares. Media loves those, right? Or expensive company in general. So having that valuation filter is I think, really important too.
Yeah. And now you also have factor ETFs. So can you tell us what factors are to begin with in case our listeners are not familiar with those, and how you combine them in your products like value and momentum?
50 years ago, indexing or passive really meant something. It meant market cap weighting and that's it. And it was a amazing invention. Bogle, Wellington, Wells Fargo, all these others. It's not amazing though, from the index or the market cap standpoint. It's for what it allowed, which was you didn't do anything. You just bought a portfolio of stocks, they float. You mess around with corporate actions on occasion, but that's it. But what that allowed you to do is not have a staff of 50 analysts or people updating traders because you don't do anything. So you could offer for lower cost. Forward 50 years from now, well, guess what? You can launch ETFs for low cost. They're tax efficient. So the trading gives you a structural tax advantage over active mutual funds. I think that estimates say it's about 70 basis points per year just from the structure and taxable accounts, ignoring the fees. Fees add more. So you can offer strategies that aren't market cap weighted in general, right? And market cap weighting is fine, but to me, it's never been optimal. And the reason being is that market cap weighting can expose you to booms and bubbles. So market cap weighting at its core, there's no tether to valuation whatsoever, right? Like what a crazy way to invest. You invest just based on price. As the price goes up, market cap goes up, you own more. As the market cap goes down, you own less. Now, that guarantees you own the winners and the losers go to zero. So it's a good, fine investing strategy, but it's not ideal because there's no tether to valuation. And it becomes particularly problematic when you have bubbles. And 1990s, late internet bubble in the US, people remember that. And the biggest stocks that become the biggest part of the index are often the most expensive. And there's gobs of research that show that the last thing you want in an index is the largest companies, because though they go on to underperform that sector, that country, that index, about 3 percentage points for the next decade. And you can show a chart. One of my favorite charts in all of investing is Ned Davis. They look at if you just invested in the largest stock in the stock market when at the time it was the largest, so Amazon, Apple, IBM, GE, on and on. How does it do versus the S&P? It's a horrible investing strategy, absolutely atrocious. So market cap is suboptimal in my mind. So a factor to me is really anything that moves you away from that. Now it could be value. Hey, I'm going to do dogs of the Dow, 10 stocks that have the highest dividend yield, rebalance once a year. That's a value strategy. You could do momentum, which we love. You mentioned VAMO, which is an odd duck. So, going back to, I don't think there's a fund in all of the mutual fund or ETF space that's quite like it. So at its core, it buys 100 stocks with value and momentum characteristics. So if you're looking at factors, all right, so we want cheap stocks that also have good momentum. So as one of my buddies, Steve Sugarwood, says, stocks that are cheap, hated, and hopefully in an uptrend. The yin and yang of investing. It's rare, but it happens.
Mm-hmm.
But then the cool thing that fund does, which is different, cool, depending on when, is it'll hedge up to 100% of the fund dynamically based on top-down levels of U.S. stock market value for roughly half of it, and then trend for roughly half of it. So it can be 100% long only, 25, 50, 75, 100% hedged or market neutral. And sometimes that's good. Last couple of years, I had a nice positive return last year. Sometimes it's atrocious. From launch through like 2020, this fund was horrific because value stocks underperformed, small cap underperformed, value momentum underperformed, hedging anything underperformed, hedging particularly with the choice of the S&P underperformed. So it was a stinker, but the tides have shifted. I think you can tie it back to interest rates bottoming, the turn in whether it's the election, COVID, et cetera. But really there was a regime shift. Interest rates have come up, obviously a lot. Inflation has returned. It's a different market environment. The expensive stuff has already gotten killed. So we can look around and see the amount of stocks that are down 60, 80, 90%. But a lot of the value stuff hasn't quite really benefited. So this could be, the fund is currently, I think the strategy is like 75% hedged. Don't quote me on it, but maybe 100%, somewhere that 50 to 100%. But it updates weekly, so that can change quick. But it's a cool idea because it's a strategy to say, look, I want to invest in stocks. I want the good stocks. But also, if we go through a long bear market, 20, 40, 60, 80%, like I want to protect, I want to survive. So nothing quite like it. Doesn't mean it's for everyone. Doesn't mean it's necessarily for anyone. We like it, but it's different. We'll give it that.
Yeah. And you also have some interesting thinking around what is actually passive allocation, right? Because making a investment in, let's say, the S&P 500 index fund, yes, it is passive, but you're actually actively allocating to U.S. large caps equities, right? And you have some products that address kind of the entire tradable asset market. So how did you approach that?
Yeah. So we love to say that market cap is the only passive portfolio. So people think of stocks, but then there's the global passive portfolio. So if you went out and bought all the public assets in the world, what does that look like? It looks like roughly half stocks, half bonds, half US, half foreign. And it shifts over time a little bit, but it's actually been a really great portfolio historically. It's hard to beat. I think it's better than 60-40. It's more diversified. We launched at the time the first ETF with no management fee. So we don't charge a fee on it, but it's a fund of funds. So it owns underlying ETFs, some of which are ours. So we'll probably break even, maybe make a little bit of money on it. But that wasn't my goal. My goal was to say, I want to launch a global market portfolio, but without the drawbacks of a global market portfolio that's market cap weighted. So I want this to be tilts towards value and momentum. And I want to make sure it includes real assets. The two big missing pieces from the global market portfolio, I think, are really single family housing and farming. It's hard to allocate to those two asset classes traditionally for now. So that portfolio is a wonderful buy and hold asset allocation for super low cost. There's some problems with buy and hold, I think. The biggest one being is that it's traditionally very tethered to the business cycle, to what's going on in the real world. So if you invest in assets, look, we just finished 2022, one of the worst years ever for 60-40, traditional US stocks and bonds. The global market portfolio would have done better because it has tilts towards value. It has foreign stocks. It has real assets, all of which did better than traditional 60-40. But still it's buy and hold. And so it still has this tether to the economy and what's going on in the real world. And over long periods, it's fine. 10, 20, 30, 40, 50 years. It's a great portfolio. It just can be challenging for some investors psychologically, mentally, to have it all hit the fan at the same time, meaning what happens when a bear market happens? Stocks down 50, think financial crisis. Well, unemployment shooting up, recession, banks are failing, Lehman's going under, you're losing your job, and also your portfolio is going down. That's an odd combo. Like actually, you would kind of want it to be the opposite. Like I would want my financial assets to go up when it's hitting the fan in the real world, but traditional buy and hold portfolios tend not to have that feature, which makes it a little tough for people to really to sustain over time.
And this actually inadvertently goes into my next question, or it's a two-part question. Number one is, how do you get all the nice ETF tickers? And since you have tail and fail, and there is a study that I read, I think it's from 2012, that if your ticker is a real word, the liquidity is better, right? And you have tail and fail, which are tail risk hedging products that you market, I think specifically in the to RIAs themselves rather than regular investors. So how did those products come about? What's the thinking there?
The tickers, you just got to ask. I'm often surprised at what's available. But, as I get older, as we're hitting the 10-year mark on our ETFs and we have over 100,000 investors, I think about what's the main issues that people come across. And a lot of it's behavioral, right? It's messing up your investing program that you established ahead of time. Usually people don't really have a written investing plan. You should, listeners. If you don't, and you don't, because we do polls and it's like 95% don't have a written plan. They just kind of wing it. They don't establish sell criteria when they buy a position, which I think is foolish, because what happens when it goes wrong and, you become emotional, but also what happens when it goes right? You buy an investment, it goes up 10x. Like, are you going to keep it? You're going to sell it? Because sometimes it's 10x is on the path to 100x. Anyway, so writing it down helps to keep you honest, same way as a diet, as any program would do. But one of the challenges with a traditional portfolio that we mentioned is these drawdowns, and people say buy and hold, just got to sit through it. And let's clear up some misconceptions. Even Bogle wasn't a buy and hold investor, right? Like, we posted a video on YouTube that shows, he talks about trimming portfolios in the late 90s as stocks went crazy. Rebalancing obviously also has this feature, but calibrating is what some of our podcast guests call it, or over rebalancing. But there's another investing strategy as you think about what can help a traditional portfolio, and I'll come back around to tail and fail in a minute, but as you go down the list, like the investing pyramid, it's like one, invest in a global opportunity set of global stocks, global bonds, global real assets. People already don't do that. They have massive home country bias. They put all their money in their own country and that's it. Okay. They exclude real assets. B, obviously implement it with a mind towards low cost and tax efficiency. We like ETFs. But 3, have tilts towards value. We think that's important to avoid the manias. 4 is really like a concept that almost no one does, which is trend following. And trend following, look, goes back 100 years. Charles Dow has a very long history. Practitioners. Trend following is sort of like the opposite of value investing in my mind, or buy and hold. Sometimes they overlap, but a lot of times they don't. Trend following is simply, and combined with momentum, they're kind of cousins, is you want to be invested in things that are going up and out of them when they're going down. Sounds simple and a lot easier than in reality. But trend following in practice, when you buy a fund or funds that do trend following, traditionally does similar to buy and hold. I think it'll outperform buy and hold over time, but it's similar. It traditionally does it with less volatility and drawdowns. But most importantly is that it does well. Usually when buy and hold is doing terrible, trend following usually does great. 2022, fantastic example. Almost everything stunk. Trend following, managed futures, another name for it, a different cousin, did fantastic. Now, 2008, 2009, same thing. And so the problem with trend following, so people are like, why don't I just put all my money in trend following? Well, the problem with trend following is you can underperform in other periods when the S&P is romping and stomping 20% a year, but you also look different. And humans don't love being the odd one out in the room when everyone else is winning. You go to a cocktail party, everybody's talking about their vacation, new house they're buying from their Dogecoin and Tesla. and you're sitting over in the corner, nursing your Bud Light because you can't afford a more expensive drink. And they struggle. So we came up with a balance. We call it Trinity, and we run momentum funds too. But Trinity is basically half buy and hold and half trend. Now, that's probably more trend than any investment advisor in the country. I don't know anyone that does more than 50 as a base case. But we think we've been running this for over 5 years now, Trinity Strategies. And to us, the whole point of this game we're playing is to finish, right? To reach that funded contentment, as my friend Brian Portnoy says. That's the whole point, right? And so if you don't get to the finish line, if your chips get taken away, if you get taken out of the game, everything doesn't matter. And so having a path and investing structure, because there's times when buy and hold will do great, and there's times when trend will really shine. But the combination of the two is, I think, greater than the whole. This is a long-winded answer, sorry. So on the way to tail risk, it's like all these other things you would do first. So we mentioned all these steps, and trend is one of my favorites, my desert island strategy. But even then, there's periods where either an individual market like US stocks hit a 10-year PE ratio of 40 during this last cycle. I thought they might eclipse 1999, but they didn't. They were close. 99, they got to 45. Now, historically, there's other markets that have been higher. Japan got almost 100 in the 80s, which is astonishing. So it can get crazier. And others have been in the 60s, but we got to 40. We're back down around 28, 29, I think. But thinking about hedging your risks, I don't think really anyone agrees with me on this. We just published a Twitter thread and a blog post called Things I Disagree With, that things I believe that 75% or more of my professional peers would disagree with. And we're up to 20 now. But one of them is that the vast majority of investors are highly leveraged to one single market, which is US stocks. And the example we give is, let's say you're a stockbroker. They don't call them stockbrokers anymore. Let's say you're a financial advisor. You work for Merrill Lynch. Well, you own stocks in your own portfolio. Even if it's diversified 60-40, the stock volatility swamps the bonds. So really it's mostly stocks. And as we know, almost no one owns a meaningful amount of foreign. Average investor in the US puts over 80% in US stocks. Huge home country bias. Okay, so that's 1 times leveraged. 2, your clients own US stocks. And so your fee-based revenue is very directly levered to that. 3, when it hits the fan, so let's say the market goes down 50, guess what clients do? They panic, they withdraw, they sell, they say, you're an idiot. Why'd you put me all in US stocks? 4, if you don't own your own company, even if you do, it might go out of business. But 3, you may work for Merrill, and Merrill's like, all right, well, we have to downsize. What are we seeing right now in the economy? Super low employment, but a lot of these tech companies are saying, okay, we're laying off 20% of the workforce. So 4. So the market's down 50. Your net worth, your portfolio just went down 50. Your revenue went down 50. You may lose your job, on and on. It's like, why in the world do you want to lever everything to one economic outcome, which is most of the time it's good, but when it's bad, it's life-changing bad. And so we thought about this and we launched a strategy. And a lot of times we use dozens of other companies' ETFs, but sometimes we look around and say, there's nothing out there that we want or would like to use, or we would like to do it different. And in this sort of inverse space, a lot of the funds were either really confusing, complicated, or really expensive. And so we said, can we build a better product? We think so. And so we came up with a strategy. We wrote a white paper on it. And we said, what if you just paired buying a ladder of puts, so 3 months on out to 15 months on the stock market, rebalances once a month, and the collateral sits in bonds, so you get some income, more now than you did a year ago. But historically, that strategy does a pretty good job of hedging the times when it really hits the fan. Like any insurance, life insurance, house insurance, it's probably going to lose money most years. But when things go bad, and when they go really bad, it's usually a good allocation to make. So to me, that's like the seasoning on the end of the portfolio. You got to do all the other things right. But if you think about, hey, I really want to protect going to bed tonight, waking up tomorrow, and the stock market being down 20, which has happened before, what could I add that would help? And let me caveat this. I like to say this is not probably a Sharp ratio optimization, optimal portfolio to add this. In fact, most investors may not need it. It may be a cost, but you wake up on that day, and it wasn't too long ago when we were watching the futures at night, stocks were going down 8% every day during the pandemic, where you pull up your portfolio and like, oh my God, red, 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 green, right? You see something that's like helping you sustain. I think that's psychologically worth something. So we own quite a bit of it in our company balance sheet, paired with Trinity as a way to balance some outcomes. Not for everybody though. A lot of that, I could say that that's tagline for all of our funds. Weird, concentrated, different. We think they're great. Not for everybody.
Yeah, which kind of rounding off the different strategies, and you have couple three oddball ETFs, low AUM, cute tickers like BODG for real estate and so on. And one thing I absolutely don't like in the ETF industry is what they do is when you have a low AUM ETF, it gets shut down. And it gets shut down at like the worst time, like KOL, the coal ETF got shut down.
Oh man, I want to relaunch it. I tried to email Jan. I said, Jan Van Eck, I said, can I have the ticker now? Are you done with this? Can I just relaunch the same fund? I would have taken it over. Why? Just give it to me.
Or SPAC, right? Like it ceased existing after launching pretty quickly. So how do you think about these low AUM products? Is it like a laboratory, or like what's the thinking there?
Well, let me give you some non-consensus perspective. The bigger fund companies close way more funds than the small fund companies. And the reason why, and this isn't everybody, but some of the big fund companies, they say, ooh, what's the hot trend today? Disruption. What's the hot trend now? Managed futures trend, whatever. And so they take 20 funds, they throw them against the wall, and if they don't scale, they close them and they move on. The mutual fund industry, over 10 years, roughly half the funds go away. So this isn't anything new, right? And so this has been going on forever. I hate it. And so when we launch a fund, we plan on never closing it. That's the goal, right? We've never technically closed a fund. We kind of repurposed one, but we've never closed one. And the small size, to me, the way it has to be viewed is as a portion of the overall lineup. So even if something is at 10 million and technically losing money, that's not how I view it. I don't care. If I launch something, I'm giving that sucker minimum 5-10 years, right? Like there's plenty of environments you launch something and you're like, this isn't the right time. One day the world will see how brilliant this strategy or Meb is and come around. And we've seen that many times with some of our funds where, look, value investing wasn't in favor for the vast majority of our existence as an ETF company. Our largest fund, our oldest fund, is a value fund, and the strategy is killing it right now. So if I had shut it down after 5 years, it would have been a huge mistake. So we hopefully will never shut anything down. Usually it's pretty orderly, but again, I think the general practice, what you want to do is align with a fund company that has a soul. It could be Vanguard. Hopefully it's Cambria. That launches funds they believe in rather than, hey, what can we launch that people will plow money into, the hot dot? No, I want something that the PM is putting his own money into. Like if you go on CNBC and you're hawking some, strategy, every interviewer should be like, okay, how much do you have invested in this fund? Because the answer for me is like, I put all my public assets into our funds. Like it's crazy not to. You got to have skin in the game. And it's crazy to me. And it made sense later. I say, because a lot of these guys don't invest in their own fund because they know it's garbage and it's too expensive. So it makes a little more sense. We hope we don't ever close any. Now, that having been said, we're going to probably launch a dozen more in the coming years, some of which are going to be totally blue ocean new ideas where there's nothing out there quite that exists. And I will not be that head in the clouds guy that says, no, everyone has to accept this idea that's new and different. Maybe it's just actually a terrible idea that Meb came up with, right? Like I'll be honest and say, okay, look, nobody wants this. I'm at peace with that. But today, knock on wood, that hasn't happened yet. So the whole point of this takeaway is like, you want to find the fiduciaries that are either required by law or out of their goodness of their heart, acting in your own best interest in a partnership rather than as a product provider. And I think that's important.
Meb, thank you for joining us.
Oh, it's been a blast. Well, I'll do it again.
This was Meb Faber, founder and CEO of Cambria Investment Management. We'll have all the relevant links in the notes. My name is Nick Mazing. This is Signals by AlphaSense. You can subscribe to us on all the major platforms. Thank you for listening.
Thank you for joining us. This was another episode of Signals by AlphaSense. Keep in mind that all views presented here are the views of the guests and hosts and do not represent the views of their employers or of AlphaSense. Nothing in this podcast constitutes investing, tax, legal, or medical advice. If you enjoyed this episode, leave us a rating and review, and subscribe for more.